In today's episode of the MSA Rental Market Update, we are looking at the Charleston rental market for conventional multifamily properties, and that is Charleston, South Carolina. As you can see that the metro statistical area is drawn out here by CoStar and where it is in relation to Atlanta. Raleigh-Durham is up here. Here's Charlotte. We've got Nashville up here, Jacksonville, Florida down here, Huntsville, Birmingham, and where I currently live in Mobile, Alabama. Let's go ahead and take a look at the filters. And as we can see, we are excluding all corporate, all military, all senior, and all vacation. And we are only looking at market and market affordable so that we are looking at conventional apartments. If we go to location, you could see that we are in market, metro statistical area, Charleston, South Carolina. So let's go take a look at the analytics and see what the supply snapshot shows us for all asset classes combined in the Charleston metro statistical area. So here is the supply side snapshot for Charleston, South Carolina. You can see that there are 753 properties in the market totaling 66,332 units. There are currently 4,720 units under construction, and in the last 12 months, 2,020 more units have been rented than have gone vacant, where the prior 12-month period, 4,192 more units were rented than went vacant. And we can see that the absorption is slowing in our vacancy. We were at 7.8% 12 months ago and now at 9.3%. If we look at our market rent, it did go up year over year by 5.6%. We'll see what it looks like quarter over quarter. As usual, we are not looking at the capital market. We are only looking at the space market. If we come down, we can see that with our long-term occupancy average, you can see we have all over 22 years, that we have a market that likes to be about 91%, and we're somewhere around 90.5. One can argue that we are on that long-term occupancy average, albeit on the bottom side of it. At the end of this video, if you stick around, we will go ahead and plot where the Charleston, South Carolina market is on the market cycle chart. So let's go dive into the data and see what the rent analytic data looks like for all three asset classes combined. So here is the rent analytic data for the Charleston, South Carolina metro statistical area. We do not look at asking rent. We don't care what the owners and management are asking. We only care what they are collecting. So we are looking at effective rent. In the first quarter of 2022, it was $1,588 a month. Went up to $1,677 in the second quarter. Slightly up, you can almost say stabilized at $1,680 in the third quarter, down to $1,655 in the fourth quarter, and then it ticked up in the first quarter of 2023. Now, we've seen this tick up consistently this week. Let's see if demand supply principles say it should have done that or if it was just raised arbitrarily. So if we come on over and look at our deliveries to absorption, we could see that 252 units were delivered in the first quarter, 730 absorbed. That is great, strong absorption. Then 336 delivered and another great, strong absorption of 671. Then things start to go a little south. We had 1022 deliver and only 797 absorb. So only about, it's pretty close to 80%, about 77%, somewhere in there. So not too terribly bad. I like to see it above 80%. But then we have 1,181 units and only 149 absorb. And then 441 more units go vacant and only 318 absorb. So when our occupancy is ticking down as it has done since the second quarter, when it was at 92.6, went down to 92.4, down to 90.9, down to 90.8, that means that rents should be following occupancy. The rent should decline so that you can get more renters in and rent those units up. But instead, we saw that there was a tick up in rents from 1655 to 1687, which means that management just raised rents because they thought they could. That is exactly what that is saying. And the renters are saying, even though we did have some absorption, that it is definitely slowing down. Okay. So let's see what each individual asset class shows us. We'll start with Class A. So here is the Class A rent analytic data. There are 81 units, totaling 21,011 units. Looking at effective rent, we started the first quarter of 2022 at 1811, went up to 1937, down to 1927, down to 1904, and then ticked back up to 1927. Once again, let's see if demand says that it should have had an increase in rents or if it was going the opposite direction against demand supply principles. So we had no deliveries and 522 absorbed in the first quarter. Then we had 224 and 285 absorbed. So good, strong absorption. Actually, really first three quarters continue to absorb. So occupancy is increasing. And when occupancy increases, it says rent should increase. So like we saw yesterday with Seattle, the Charleston, South Carolina Class A market seems to be holding pretty strong. And they are absorbing units. We're not having deliveries, but that's okay. It is absorbing units. We're not looking at the second quarter data yet because it is way too early for that. This will be erroneous information for right now. We're only looking at first quarter 2023. So looking at Class A, telling a really good story that if you're investing in the Charleston, South Carolina market, that Class A is doing really well. So let's go back. I want to compare the Class A rents to the Class B rents. So we're sitting about 19 and a quarter, 1900, somewhere in there. Let's see what the Class B story tells us and see if the Class A might be stealing from the Bs because their rents are so close. I don't know yet, but let's go take a look and see if that's the story we get. So here is the rent analytic data for the Class B properties in the Charleston, South Carolina metro statistical area. There are 225 properties totaling 28,402 units. Looking at effective rent, started first quarter at 1603, went up to 1682, up to 1690, down to 1645, and then up to 1686. Now we wanted to compare the rents. So remember, we were at about 19 and a quarter, so it looks like we're about $250 apart from each other. So looking at the absorption will tell us whether the Class A's might be stealing from the Class B's. And what I see peeking over at vacancy says these absorptions are probably not going to be very good. So we can see that we had 251 deliver in the first quarter and 271 absorb. Good, strong absorption. 112 deliver in the second quarter, another good showing on absorption, 332. Then 498 deliver and 312 absorb, so we're slowing down. Then 1,181 deliver and only 191 absorb. Then 441 deliver and only 219 absorb. So there is a downtrend in occupancy. We're sitting, this makes no sense to me. We're sitting at 87.8% occupancy. That is 12.2% vacancy. And you're increasing rents. In what person's mind, what management company, what ownership raises rents when you have 12.2% vacancy? That just blows me away. So I can concur with the fact, since there's only a $250 difference in rents between the B's and the A's, that the A's are probably stealing from the B's in this case. But we do have some absorption, but that vacancy is continuing to increase. So if you own Class B in the Charleston, South Carolina market, your NOIs are dropping. You need to be careful. Let's see what story the Class C's are telling us. So here is the Class C rent analytic data for Charleston metro statistical area. There are 383 properties in the market totaling 16,393 units. Looking at effective rent in the first quarter, it was at $11.98, went up to $12.47 in the second quarter, up to $12.60 in the third, up to $12.71 in the fourth, and up to $12.98 in the first quarter of 2023. Let's see what demand and supply tell us by looking at our absorption. And we do have negative absorption in 4 of the last 5 quarters. Really, we could say 5 of the last 6 quarters. Now you're not going to have any deliveries, and you're probably not building to Class C. These are more than likely going to be Class Bs in maybe lower income neighborhoods. but they will be Bs, they won't be Cs. So when we look at this absorption, we can say, well, rents should have been trending downward, but is that really the case? Look at our occupancy. So our occupancy is sitting at 94% right now. If I'm in the Charleston, South Carolina market and I'm an owner or a manager and I'm at 94%, then I am probably still increasing rents. We don't start to think about lowering rents until we start to get close to that 90% mark, because we know the property is more marketable if we decide to sell for agency financing, as if it's above 90% occupancy for the last 90 days. So owners don't start getting worried until they get around that 93%. And as they get closer to 90, they start to get even more worried, which is why it surprises me that we are below 90% in the Class B space in this metro statistical area. So what does all this mean for Charleston? Well, if we pull up our market cycle chart, we know that we are lowering in absorption. So absorption is waning in Class A and Class B, albeit still, actually Class A was still pretty strong. So Class A, we had 2 quarters of rent decline and then that 1 quarter towards the end of rent increase. And according to what we saw in absorption, it really should have had increases in those rents every single quarter. So we could probably be comfortable putting the Class A's around equilibrium, maybe even on this side of expansion like we saw with Seattle. For the Class B's, we were definitely showing signs of slowing in the absorption and declining in the rents, except for that first quarter 2023. So and well below that long-term occupancy average. So I would place the B's, if I were to separate everything out, either on the long-term occupancy average or maybe slightly below it. And with Class C's trending downward, but above that long-term occupancy. Remember, we were negative absorption. Rents were increasing, but it's because it was only at 94 or 6% vacancy, 94% occupancy, putting it about 3% above the long-term occupancy average. So I would comfortably put the Charleston, South Carolina Class C market right here. But what about the overall market? So we know A's are propping it up and looking good. We know B's are dragging it down and C's are in the middle. So I think we're pretty comfortable because of the A's and the C's plotting it either between the long-term occupancy average and this point in oversupply, even though we know that our long-term occupancy average is sitting on the horizontal line. So if you remember, it was 91%, and we were right about 90 and 2/3%. So right on this long-term occupancy average line. So I'm pretty comfortable putting it here or here, all right, for the overall Charleston metro statistical area in oversupply. So that does it for the Charleston metro statistical area. Tomorrow we will be looking at Little Rock, Arkansas. We will talk to you tomorrow.